What is going on, guys? Here are three stocks that I'm very bullish on and have been buying in the last couple of weeks and their price targets. First up, TMDX, Uber, and Goeasy. And since it is the first video of 2025, I will be sharing another 5 stocks and 1 ETF at the end of the video. First stock I want to talk about is Uber. The last video I made was a deep dive into Uber, so I'm not going to go too much into it, but the main thing I want to do is the discounted free cash flow so you guys can see the fair value of the company. So if we take a look at Uber right here, we can see that the company has been growing its revenues and has been growing its cash flows, and in the same time the stock price has not been following. We can see that the revenue is growing at a CAGR of 30% while the stock is growing at a CAGR of 8%. The reason I have not been buying Uber until now is because I thought they would never be profitable, but they have shown to be profitable and they're growing their free cash flow projected to grow by 30% for the next 3 years. Now, if we put that into our discounted free cash flow for shares outstanding, the CEO did talk about that in 2025. They will be doing a lot of share buybacks. So in 2024, they did buy $300 million of their shares, but because of stock-based compensation and paying themselves, the shares still increased. So to be conservative, we're going to say the shares outstanding stays the same, even though it should go down. We're going to stick with a 30% free cash flow growth, which they said they would for the next 3 years. The price to free cash flow for the last 3 years has been 44 times free cash flow. We're going to be very conservative and say 25 times free cash flow and give it a 10% discount rate. So even with all this, the fair value is at about $117. This stock is sitting at $66 right now. So to say the least, I'm incredibly bullish on Uber and have been buying it, adding it to my portfolio. I like the business, I like the valuation, and I see a lot of potential in Uber. Right here, we can see the total addressable market in a lot of these countries. And we can see that they have been growing and even 11xing in Argentina and growing in all over Europe, all over the world. And I think the growth will continue. And they are releasing a lot of cool different business models to adapt to different countries so that more people will use it. So if you want to know more about Uber, check out the last video I made. But now let's get into the next stock, TMDX, Transmedics. So this stock was trading at $170 a share, and it had a bad quarter and it had a huge overreaction and dropped all the way down to $62. So first, I want to apologize for not making this video earlier since I did buy in. My average is about $66 and now it is sitting at $75. But I wouldn't be making this video if I didn't think there's still a lot of potential and it's still a good opportunity to buy now. So before we dive into the stock, let's watch this video about what they actually do.
The Bloom Cardiovascular Institute at Northwestern Medicine. Using the Transmedics machine really builds on the traditional principles of organ recovery and transport. Where it really pays off is in lowering the waitlist times for patients, because suddenly you have the whole country open to you as far as donor hearts that are available. You can seize the moment much more easily. It's allowed us to get really high quality, long lasting donor hearts for our patients that we otherwise wouldn't have been able to. So one of the important ways that the Transmedics device has expanded the potential pool of heart donors and thereby decreasing the wait list is by letting us use hearts through a process called donation after circulatory death. So what that means is that there are a pool of donors who, similar to the traditional pool of donors, have had a catastrophic brain injury or anoxic injury or trauma and are never going to recover, but they don't quite meet the legal standards for brain death. And if they can't be declared brain dead, then they can't go through donation of a heart through the normal pathway. Through donation after circulatory death, these hearts are matched to a recipient, but then the donor is allowed to die and have their circulation stop. And then we immediately resuscitate the heart, reanimate it on the Transmedics machine. It's exciting because otherwise these hearts couldn't really be used. We just would have to tell the family, I'm sorry, your loved one doesn't meet our criteria to donate their heart like they wished. And so it is exciting, I think, because we can bring down our waitlist time and allow more families to honor their loved ones by facilitating heart donation.
Thank you, Dr. Ben, but you guys get the gist of it. They're an organ transplant company. Very niche, very easy to understand, and a lot of growth ahead. And the best thing is they have over 400 patents on their technology, and they're the only guys doing this right now. So they have a little moat. So these guys currently do have a moat, and we can see that they have been growing outstandingly. And just because of the last quarter, the stock price has sold off, and I think that's why it's an opportunity to buy right now. And here is why I'm very bullish on them right now. We can see that they use their own private jets to transport the organs. and they have 18 jets, but only 10 of them are currently working. So they can pretty much double their capacity, which would mean double their operating income. Just because they didn't perform very well in the last quarter doesn't mean that they aren't on track to hit their targets. We can see that in next year, 2025, they project to grow their earnings per share by 84%, revenue by almost 40%. And the growth up till now, we can see last year revenue increased double, 100%. Their balance sheet is very good. They have 300 million on their balance sheet, a lot of cash runaway, and almost no liabilities. So this company is not perfect. They have high stock-based compensation, and you can see they are not profitable. Their free cash flow looks horrible, and that is because they have been investing into the airplanes, buying more jets, doing maintenance, and having them ready to go. And we can see that on the balance sheet. If you look property, plant, and equipment, it went from 170 million to 270 million. So they added that $100 million of assets into the planes they need to do what they do. And in the same time, the liabilities barely went up by not even $10 million. So these guys are conservative and are disciplined with their money. And that's what I like to see in the management. And if you look at their net income right here, it went from 9 months ended 2023 at negative 30 million to almost positive 30 million. So they are on the right track to profitability. So the stock is still down 55% from its all-time highs, and the institutions are buying. So if you guys want to deep dive into the stock, comment down below and I can dedicate a whole video to it. And I think this stock, a lot of you guys are going to like. They've been around for 33 years. Since 2019, they've grown at 20% CAGR, the revenue, and they're selling at 9 times earnings and 8 times forward earnings. Now, valuation-wise, this is the cheapest company. They also pay a dividend, a very safe dividend. They've been profitable for as long as I can remember. I like this company because they're very niche in what they do. So they do give out loans, and their average interest rate is 30%. So they make 30% on the money they give out. Now, what is interesting about them is they're hitting customers that pretty much nobody else is. They're right in the middle, looking for people that have under 600 credit score, that don't have a very good credit score, that are average age of 43 years, average salary is $60,000. Now, if you look at SoFi, their average customer age is, I don't know the age, but the average customer income is at $120,000 and the credit score is above 700. So these guys are looking for the opposite sector. So they target the guys that can get a loan from TD, CIBC, and the big 6 banks and don't want to go to Cash Money or Money Mart. So they're right in the middle kind of. And what scared me is the delinquency rate. Is if they get these people that don't have enough money, they won't be able to pay them back. But they actually do. If you look at their delinquency rate, which means not people that aren't able to pay back on time, it's only 5%, 5.8%. If you look at SoFi, it's between 3 and 4%. So they're doing pretty well. And they're still on pace for a lot of growth. We can see that 2023 full year, everything was double digit, over 20% growth. And if you look at, it is their 93rd consecutive quarter of being net income positive, the 20th year of paying dividends, and the 10th consecutive year of raising the dividend. Again, they have a 2.7% dividend. So I do like Goeasy. It is more of a safe play. There's not that much upside. But what I'm looking for is, I think within the next year, it'll be over $200 per share. And it is currently sitting at 170. So looking at this stock, it has a very good margin of safety. There is not much downside. I don't believe this stock will be selling at 5 times earnings, and if it does, I will buy a whole lot of it. And it does have upside to $200. It's a nice 15% gain, and along the way you get dividends and the growth continues. If you made it this far in the video, thank you very much, and I want to give you some hidden gems. First one is REXR. Now this is a REIT, industrial REIT, that pays a 4% dividend, and if you look at this, it's been growing the revenue at 30% CAGR year over year since 2015. And if you look at the price they're selling for less than they were in 2019. If you look at the price to operating income, they're sitting at 24, which is the lowest it's ever been. It was 90, 100 before. So this is a high quality REIT that I'm considering buying and doing more research on. We can see that for the last 10 years, they've grown their dividend at a CAGR of 13%, and they plan on growing it at 15% CAGR. So it's a growing dividend, 30% growth in revenue that I believe they can keep up. Highest dividend it's ever been. Next up, we have a fintech stock, NU, or New Bank. Now, this bank has over 50% of adults in Brazil using them, and they have been growing and expanding into other Latin countries like Mexico and Colombia. And if you look at the growth, just phenomenal. It is down 30% from all-time highs, and it is trading at a forward PE of 17. Now, if you look at the insights of this company, it got a 4 out of 5. There's I like to see everything I see. Low stock-based compensation, very good gross margin, 16% net margin, which I think will improve and get even better. The current ratio is not the best since they are doing a lot of expansion and reinvesting into the company, but the growth has been phenomenal, and analysts project a lot more growth, 70% earnings per share, 44% revenue. So for this company to be selling at 18 times forward earnings, I think it is undervalued. All right, guys, I've just been throwing these stocks at you, but this is the last one. Evolution AB. So this is a gambling company, and it is selling at a forward price to earnings of 12. And if you just look at their insights, it's just ridiculously amazing. Operating income 63%, free cash flow margin and net margin of 55%. So this is an incredibly profitable company, and the management has been doing great with the money they've had. And I think the growth will only continue. And it is actually growing a dividend, has a dividend yield of 3.4%. So this is another growth dividend stock that I think is very interesting, and I'm digging into as we speak. So thank you guys so much for watching. For 2025, I will be posting 1 to 2 videos a week. So if you want to see some more cool stocks and finance tips, stick around.